Hello and welcome to the Global View on this Thursday. Well, US third quarter economic growth has been revised upwards to a 5.2% annualised rate, marking the fastest pace of expansion since the fourth quarter of 2021. The GDP report also confirmed inflation is trending lower, with slight downward revisions to measures watched by the Fed. The report was accompanied by further Fed speak, with Atlanta President Raphael Bostic saying he expects US growth to slow and inflation to continue to ease, saying, "I don't think we've seen the full effects of restrictive policy. Another reason I think we'll see further cooling of economic activity and inflation." However, Richmond Fed President Thomas Barkin saying he's sceptical that inflation is on its way down to 2% and wants the option of another rate hike in case inflation gains steam, saying, "If you believe as I believe that inflation is going to be stubborner than I would like it to be, then I think talking about reducing rates at this point is premature." Well, US Treasury yields have fallen further as the latest reading on economic growth failed to derail market expectations that a Fed rate cut is on the horizon. The yield on the 10-year Treasury note falling to 4.27% and the 2-year down around 8 basis points to 4.65. And the US dollar has climbed from its lowest level in more than 3 months as investors consolidated positions after 4 days of losses. The Aussie dollar trading at 66.2 US cents. Well, the seasonal upswing continues, says our next guest, but what's ahead for 2024? Sam Stovall is the Chief Investment Strategist at CFRA. He's joining us now. Sam, very good to catch up with you again. Thanks for joining us at ausbiz. So we've seen some impressive gains across November. What are your expectations? Has this Santa Claus rally still got legs? And what are your considerations at the moment?
Hello, Andrew. Good to talk to you again. Yes, I do think that the market still has some upside potential. This time last year, I set our 2023 target of 45.75. So we're pretty close to that target right now. And I do believe that we're going to head higher in the month of December. December is the third best performing month for the S&P 500, but the best in terms of a batting average, frequency with which the market has advanced, doing so more than 3 out of every 4 years. And also you have to add the presidential cycle to the mix. The fourth quarter of the pre-election year has never declined for the first-term presidency since World War II. Ditto for the full election year, whether the incumbent is replaced or re-elected.
So, Sam, have you managed to come up with your target for the S&P 500 for 2024 then?
Well, the target is going to be released on the December 11th, so I can't really give out what we don't have just yet. But when we look to some factors that are historical in nature, as I mentioned about the election year of first-term administrations, the average total return was 15.5%. We are in the second year of a bull market, which historically has risen about 12.5%. And when we look to earnings growth in 2024, our expectation is for an 11% rise in earnings. So each of those numbers is a double-digit gain. So I would tend to say that investors will likely be happy with the results of the coming year as they were with this year.
Sam, how's the macro environment playing out just as far as your strategy there is concerned? Obviously, given we've just had that read on GDP, of course, backward looking. But look, I guess more focus on what the Fed is likely to do next and the prospect of rate cuts, whether they come in the first half or perhaps later. How's that influencing your investment decisions there?
Well, similar to what Fed President Bostic was saying, is that we believe that the Fed has ended its rate tightening program. And oh, by the way, in the period between the last rate hike and the first rate cut, which has averaged 11% since 1990, or 11 months, the market has risen 14%. So we think that the Fed is done. However, they're probably not going to start cutting interest rates until the third quarter of 2024 because we do believe that they want to remain high for longer because they want to ensure that the embers of inflation have been fully extinguished. So I think they're going to take their time in when they're going to actually cut.
How's this playing out for the US consumer? What have you seen? We've just been through, obviously, Black Friday, Cyber Monday, as we lead into holiday spending season. Yet, as we're seeing on this side, the households are very much under pressure at the moment, particularly where given those interest rates have gone. Where do you think the US consumer is at the moment, just in terms of their spending?
Well, we're seeing that the Black Friday sales, the Cyber Monday sales were much better than anticipated. And even though we are seeing a creep higher in consumer debt, it's still below the median level over the last many years. So yes, they're adding to their debt, but it's something that can still be managed at this point. Also, with the 10-year yield coming down, and our expectation is that it'll probably end up approaching the 200-day moving average fairly soon, but remain in the mid 4% area into 2024. Our belief is that the consumer can continue to spend, and that we're looking actually for earnings increase for the retail composite of about 13% in 2024. So the consumer is certainly not out of it yet, especially when the banks are willing to lend even at these slightly higher interest rates.
You're seeing a change in how they spend. Interesting to note that buy now, pay later clearly has some tailwinds there, as I guess consumers are feeling the pinch and delaying their payment of debt.
Well, a lot of times I think investors would just rather put off the negative, and the negative is having to pay for what they just bought. But yes, that could end up being a concern as time moves forward. But it certainly will allow the retail audience to continue to purchase moving forward, certainly longer than they might have if they had to pay for everything up front all at once. So I still think that the consumer is likely to be a contributing factor to the stock market's growth in 2024, along with technology and communication services, primarily because following up years, you want to stick with your winners, not rotate to the losers.
Well, speaking of which, Sam, you mentioned technology there. Clearly, particularly in the first half of the year, that growth, substantial growth led by the Magnificent Seven, of course. Is that momentum, in your view, likely to continue?
Yes, it is. Historically, after down years, and remember 2022, we were off by 19.5% for the S&P 500. Investors typically rotate from first to worst, meaning they move out of the sectors that traditionally held up best during these down years, such as consumer staples, healthcare, utilities, and gravitate toward those groups that were beaten up the most. And in 2022, they were communication services, consumer discretionary, and tech. So hence the outperformance by these three sectors this year. Following up years, you want to stick with those winners. Let your winners ride, because that tends to add at least 200 basis points per year to the market's performance by just sticking with those that have done well.
And is that likely to hold true into next year, do you think, just in terms perhaps of those sectors likely to underperform?
I think that maybe these underperformers might end up drifting toward more of a neutral status, if you will. I would tend to say that there's an awful lot of overhead resistance for a lot of these groups that have been underperformers. And once they get back to the level at which investors purchased, the investors likely sell them to say, let me move on from these dogs and move on to something that's done a lot better. So I would tend to say that at least as we enter 2024, investors will be sticking with the growth area of the market.
Sam, do you have a view on the small cap end of the market, given it has clearly struggled, particularly in the face of those rising interest rates? Do you see a change?
Yes, I do. In the last 10 years, small cap and mid cap stocks have underperformed large cap stocks 8 of those 10 years. Right now, we are looking at relative PE ratios. So the PE on forward 12-month estimates for both the mid and the small cap arena being greater than a 30% discount to the average over the last 20 or so years. So I think that these stocks are very attractive at this point. And if investors are saying, well, I'd rather just tiptoe back into these categories, they can do so with the high quality stocks or high quality ETFs associated with both the mid and the small cap indices.
And Sam, overall, how do you see the performance of the US equity market into next year compared with its global peers?
Well, I think that the real question is what's going to happen to the economy. We believe there will be no recession here in the US. However, we have individual countries in Europe that are in recession, and the EU likely to also be teetering on the precipice of recession. So I think investors are going to stick with the US at this point. But here is another area that looks very attractive. The Developed International Index, the S&P International Developed Index, is currently trading at about a 20% discount on its relative PE basis over, again, the last 20 plus years. So an area that has been an underperformer for quite some time. If you believe in reversion to the mean, we could also see this group improve its performance in the year ahead.
Sam, great to get a view of your investment strategy at CFRA. Thanks so much for joining us.
My pleasure, Andrew.
Quick check of the market. We are expecting a relatively flat open when we get underway in just a couple of minutes' time. As you can see, SPY futures there up just 5 points. Also a reminder, if you've wondered about the secrets of success in stock picking, well, now's your chance to join Stock Doctors Daniel Artesi and Tim Lincoln as they lift the lid on the filters and processes they use to pick stocks and power returns. That is happening today, 11 a.m. Eastern, live or on demand. You'll unlock some of those secrets to the Stock Doctors Star Stocks Funds, which has yielded more than 17% per annum since its inception. So here's your opportunity to ask them questions of how they do it. It is free to register and you still have time. You can head to ausbiz.co/stockdoctor. Stay with us, the open is next.